Welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Let's start, as always, with a look at the markets. Now, so far in Europe, we are seeing equity markets trading slightly lower, tracking the losses really that we saw yesterday evening in the US session. We saw similar losses again in Asia overnight. We are seeing US markets now open around 15 minutes ago, trading relatively mixed. Mainly the main driver behind these losses late in the US session yesterday and carrying over into Asia and Europe today is on the back of the Fed and rate hike expectations. Now, I've mentioned on numerous occasions how we've seen clear hawkish tones and rhetoric coming from different Federal Reserve officials, how the data has potentially been better than the markets are expecting, and maybe the markets are incorrectly pricing in the potential for a rate hike in the US this year. The market's previously pricing in only a 4% chance of a rate hike in June. The first rate hike then coming in December. But it seems that the events of the last couple of days are starting to finally wake the markets up to the potential for more than one rate hike this year, and more importantly, a potential even for a rate hike in June. We had, of course, the inflation figures, which were better than expected, and this was followed then by three Fed officials who spoke yesterday evening. We had Dennis Lockhart and John Williams at an event yesterday evening on a panel discussion, and we also heard as well from Robert Kaplan. Now, it's worth noting before I say anything here that none of these officials are actually voting members of the FOMC this year. Robert Kaplan is a voting member next year. Dennis Lockhart and John Williams were voting members last year. But I think the important point here, and this is what I think the markets are finally starting to latch onto, these three are all generally seen as centrist members of the Federal Reserve, which means they're neither typically dovish or hawkish. The fact that all of these three all came out with some very hawkish rhetoric, a couple of them suggesting that we could get 2 or even 3 rate hikes still this year, again suggesting that the markets were incorrectly pricing in the potential for rate hikes, and at least a couple of them talking about June as being very much a live meeting, and the markets have got it effectively entirely wrong in its pricing for the June meeting. This has really woken the markets up, because this suggests that the Fed officials, which could potentially be on the fence at the next meeting, are actually leaning in a far more hawkish direction. And if these three are, regardless of the fact of whether they are voting members or not, maybe this does suggest that there is a more hawkish consensus building in the Fed, and the markets are incorrectly pricing. Now, immediately we did see a response in the markets. We saw equity markets selling off slightly. We saw some support in the dollar. More importantly now, the implied probability based on Fed funds futures of a rate hike in June has gone up to 15%, and now you may say that this is still way below the 50%, which the Fed may actually start to consider raising rates, with the idea being that they won't cause too much market volatility, or even higher. Maybe you're looking more towards 60 or 70%, but it is a start. We've moved from 4 to 15% within a day, and the Fed, this could potentially provide the building blocks for the markets to increasingly price in a potential come June, if that is exactly what the Fed wishes to do. And also the first rate hike based on the markets now is actually in November, so clearly the markets are coming more around to the Fed's way of thinking rather than the other way around, which we saw earlier on this year. Now, this brings tonight's FOMC minutes very much into focus. It was, of course, already going to be a key event, but the fact that we are getting this more hawkish rhetoric from a number of the Fed officials now, this does seem to be a united effort from the Federal Reserve. If we get an equally hawkish minutes now from that last month's meeting, then I think this will lead to an increasing pricing in of a rate hike in June in the coming weeks, and bring forward the potential for at least one, maybe even a couple of rate hikes this year. So very interesting developments on the Fed interest rate front that we've had so far today. I guess the other place where we've really seen some moves today is in the pound. Again, Brexit is going to be at the forefront in the coming weeks for the pound. We did have some employment data which we can see on the economic calendar here. Actually, you can see we had some employment data from the UK. Not an enormous amount coming from this. Of course, we had the unemployment rate remaining at 5.1%, claimant count falling unexpectedly. I guess the most notable thing here is the average earnings rose by 2%, including bonus. Excluding bonus, which is seen as the more reliable number, actually fell to 2.1% rather than rising to 2.3%. So really relatively mixed employment data that we had from the UK today. The most notable thing, though, which I think is what's spurring the pound higher, is that we are seeing more and more polls being released now in relation to the Brexit vote, and they do seem to be moving more and more in favour of the UK remaining within the EU. Now, we had one today from Ipsos, and they showed an 18-point lead for the Remain campaign, far more in line with the polls which we had earlier in the week. It's also far more in line as well with the betting odds, which are generally seen as being the more reliable indicator in this case, as we saw back for the Scottish referendum and also the general election last year as well. Now, I guess this is now starting to finally make people believe that we are far more likely to remain in the UK, in the EU, of course, but also that it's not potentially going to be quite as neck and neck as some of the polls suggest. I guess the important thing about this poll and a couple of others which we've noted so far this week is this was a telephone poll, and again, in the last Scottish referendum and in the election that the Conservatives won, the telephone polls were found to be far more reliable indicator of people's eventual voting patterns, more so than the online polls. So I think this is what gives this particular poll that additional bit of significance, and that again is why we are seeing the pound getting a little bit more support today. But like I say, going into the end of the session now, the key event is going to be those FOMC minutes. We do also have EIA crude oil inventories for those of you who are trading oil. Oil's trading relatively flat today, struggling to move above that $50 barrier, which it's come up to in the last few days, again on the back of those Goldman Sachs comments and on the fact that there are rising beliefs that this market has moved into deficit now, which means we are no longer seeing this supply exceeding demand scenario that we've had for much of the last 18 months. But we are seeing it find some resistance around that 50 mark. So maybe if we do see another, drawdown in inventories today, then that may be what spurs oil above that 50 important psychological $50 mark. But so again, a couple of key events today: the EIA crude oil inventories, but even more so, we've got the FOMC minutes to come later on this evening. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.